All right, good afternoon, everybody. Chris Lester here. This is a topic, with all the volatility in the marketplace of late and in the foreseeable future, we're going to, be nervous, right? So, the closer you get to retirement, the less risk we can afford, but it seems like the pendulum is swinging not only further and further left and right, but faster and faster, right? So, we have 2 or 3 good days, 2 or 3 bad days, and it's in this channel that runs. And there's economic news, there's global risk, there's sovereign risk, there's Title 42. You have a lot of things going on: inflation, politics, just all these things that sometimes the market has baked in, and sometimes surprises happen. And then you have fundamentals. And when you have fundamentals, like, has the economy cooled off? Is inflation continuing to be an issue? Will layoffs start to happen on a larger scale? Will unemployment rise? Will there be shortages of products, right? Just a number of concerns that I call those headwinds, right? Things into the future. This is not a doom and gloom type of call, but it is a sort of pulse check to say, hey, listen, as we're moving forward, a lot of people on this call are still employed, right? And as you're working, you have 401ks at work. And at work, quite often, we're limited on the types of investment strategies we can put our money into. But depending on your age, there's the first and foremost thing. It's once you reach the magic date of 59 and a half, most plans, I think I have not seen one that didn't allow this. You're allowed an in-service distribution to some degree, sometimes earlier, but at 59 and a half, usually you can start to take control of those funds. And sometimes there's wisdom in doing so. So the reason I share that is because what we're going to talk about today is a strategy that is similar to one of the investment strategies that we talk about. Right. So if you're on this call, you're one of my clients, you're familiar with something that I've called in the past, and we've had calls on, called structured notes, right? So structured notes can be negotiated with banks. They're short-term agreements, and you participate in some indices, and they typically have some downside protective mechanisms. But although they give us some pretty high rates of return, we're not necessarily in some of the broader indices. So that's what we're going to talk about today: is how can we talk about putting some strategies in place. If you have a brokerage account, if you thinking about moving some risk off the table, you'll want to give us a call and start to look at what some of the options are. So that's what this is about, is using some innovative technology to be able to de-risk some of your portfolio. But before we get into it, we have to think about, what is financial planning 101? One of the things you'll never see me sit up here and do is pitch a product, right? Hey, I got the hottest new thing off the shelf, because that's just not fundamentally sound. Typically it takes time to get to know somebody, get to know their goals as things are changing. Then once we sort of, develop that initial conversation, maybe we explore some of your current holdings and what you're doing. Then I'll get a sense for what's your risk tolerance, right? We can do that in the form of an RPQ, right? Risk profile questionnaire, or just in our conversations. I'll be like, it's sounding to me that you're pretty risk averse, or you still got some time to retire and you can afford to take a little bit of risk, but you don't want to bet the farm. And it really does depend on where you are. And then the next thing is, and I think this is really important, is how long until you need access to an asset, right? So liquidity. So these are the types of things I'm typically trying to extract from folks as I'm getting to know them, learning what their circumstances are. And then as life happens, things change. Are we nimble enough or maneuverable enough to be able to adjust and adapt? And I've had some phone calls recently, a CPA that was pretty high level at a corporation. Merger and acquisitions. His job is now being eliminated. But fortunately, we've built out a whole model where now we're able to, with at least more precision, predict what we can start to do on a go forward. So those are some of the tools I have. We'll talk about that more in the future, but things will continue to change. And, just because something has worked in the past does not always mean that that is the best option on a go forward. And I am especially pointing to 401ks. We've talked about the risk of bonds. Now, as rising interest rates, portfolio values are done. I'm not going to get into some of that old conversation, but I want to take us to this slide, which is just, from a very fundamental core basic principle. It's called asset allocation. This is just a hypothetical model. Quite often, if you're currently employed, you'll see this come, once a quarter, once a year. You'll look at it and say, hey, here's roughly the types of vehicles that I'm invested in. When I do my monthly updates, you'll see us refer to some of these types of categories, whether it be cash, U.S. stocks, non-U.S. stocks, right, bonds, or other, right? And there's some allocation. And typically, when we're working, I see portfolios anywhere from 80-20 to 70-30. And if they're really young, they're betting the farm, they might be 100% equities. So as the theory and typically the reduction of risk in the past has been, as we get closer to a end date, a date where we're saying I'm no longer going to be employed, we therefore want to take less risk, therefore less equities, right? And more into the bond arena. But that philosophy in the past, at least in the last 10 years, has been questionable because of this, what I've called the end of a 30-year secular bull bond market, right? So that's very technical. It's just bottom line is bonds have seen their shelf life of 40 years. Now bonds and the interest rates are starting to creep up. Long term, we'll start to see a stabilization and start to see where they're going to, and back to some 4, 5, 6, 7% will not be uncommon. But if you're 65 now, 60 now, 55 now, do we have the recovery time or the risk tolerance, right, for bonds? So we still may want to be in equities, but how can we do so with a little bit more assurances? So that's what we're going to talk about here today. First, before I get into the strategy, I first want to understand or explain nomenclature, right? Sometimes we in the industry will use verbiage that's, very common amongst our peers, but, the public isn't maybe quite as familiar. So ETFs. So typically you'll hear when I'm first onboarding a client, we'll talk about SMAs, separately managed accounts, mutual funds. Most of us know what those are. ETFs are exchange traded funds, right? Some type of money market account. So different types of holding or packaging of vehicles offer pros and cons. ETFs typically, in my experience, allow us, and you'll see here I'm going to read this in a second, but just, in theory, the idea is to be able to pick a selection of vehicles and do so and trade and participate in markets less expensively, right? Unlike mutual funds, which when they're in their, initial exposure to the public, 30, 40 years ago, were all the rave, but now as the layers have been pulled back, we see that quite often those are very expensive. So an exchange traded fund is a type of pooled investment strategy, right? That typically ETFs will track a particular index, and that could be sector, commodity, other assets. But unlike mutual funds, ETFs can be purchased or sold on a stock exchange, the same way a regular stock can. An ETF can be structured to track anything from the price of an individual commodity to a large diverse collection of securities. ETFs can even be structured to track specific investment strategies. And the first ETF was SPDR, S&P 500, or you might have seen it when if any of you watch CNBC, SPY, which tracks the S&P 500 index and which remains an actively traded ETF today. So, that's just saying that one of the most common indices that you will see tracked and marked is the S&P. And that S&P index, to be able to have it in the form of an ETF, they're trying to mirror that, right? So that's why it's now called the SPY. So they're the only thing that would be different would be that there be an underlying cost to that, right? But typically it's very, very efficient. All right. So then what are buffer ETFs? So Innovator created strategies. They're a revolutionary product line that offers investors exposure to price returns of a broad equity market, US equity, emerging markets, international, up to a cap with a built-in downside buffer, very similar to the structured notes that I've shared before. Historically, these types of defined outcome strategies have only been available through certain banks in insurance products. And this is why most financial advisors that are duly licensed are very familiar, because indexing, I've been using this for with clients for 20 plus years, right? So to be able to access this with some type of strategy where you're not just all in the index with all the downside risk and all the upside potential, now you can put some guardrails in place. So today, a revolutionary ETF alternative exists to help you to invest in equity markets with confidence. So the benefit of the ETF wrapper, they're cost effective, liquidity, tax efficient, no credit risk, no lockups, no commissions, no surrender fees. They can be held indefinitely, 1099 reporting. So if you're putting them into a brokerage account, you'll get 1099. If they're in an IRA or qualified plan, right, then obviously that would be tax deferred. And then buy and sell on an exchange, right? So this is Innovator. You can look them up. This is, like I said, very similar to structured notes, but now we're in equities versus, although the structured notes are, instead of having a guaranteed negotiated coupon, right? You'll see here, here's the buffer ETF overviews. I'm going to read the left side column, the investor sentiment, and then we'll get into how they can help. But, you know, bottom line is, if you're worried about the market and sell-offs, and I think everybody, if you're on this call, you've been watching the news, you've been looking at the market, you've been looking at your portfolio. I mean, we've had 4 straight days down in the S&P. I don't know what tomorrow is going to hold. Fed's coming out. Will they raise rates tomorrow? I don't know. But things are problematic, right? There's a lot of warning signs on the horizon. So any one of these things could cause a trigger. We've heard people for a year, myself included, talking about a recession's on the horizon. There was technically a recession a year ago when we have 2 negative quarters. But, you know, you'll have some people say yes, no, and it was a small one, small sliver of time. So right now, again, this is not a gloom and doom call. This is more about what can we do from a protective measure to allow us to continue to participate if hey, things go up, or even if things go down, we're just not taking a bath. So wants to stay in cash. So sometimes, you know, you were just concerned, like, you know, that's one of the things. Many studies have been done where people, you know, typically consumers tend to get out at the wrong time and in at the wrong time. And it's, I mean, so problematic that they have left in excess of 7 to 8% return over time left on the table that they could have, because they missed the best days, and they miss in an effort to avoid some of the drop-offs, which are typically short-term spikes. So that's the emotion, and we can't remove that. We are not robots. So we have this underlying, you know, normalcy, which is, hey, listen, that's fear. Fear is normal and fear is good. But we can't be reactionary when it comes to our investing. And that's why dealing with professionals, that's what part of our role is to be able to help manage A, expectations, and B, make sound strategic plans versus reactionary decisions. Prefer the safety of bonds, right? So you like bonds, but again, bonds don't like rising interest rates. And we are now, you know, knee deep in it. And so is the Fed going to do it, continue to do it? I don't know, but that's why it's going to be from even a 1 year, 2 year, 3 year time frame. Maybe we don't see bonds being that balanced alternative. Afraid of investing in high stock market valuations. That's a fundamental basic. You want to buy low, sell high. What everybody tends to, and that's what, back to the Dow bar study, what a lot of people have done in the past is they buy high. They buy at the wrong time. So right now, I don't know where the market's going. We've had 4 down days, but last week we had a couple good days. So are you saying, hey, we can't time the market? That has just been proven time and time again. and then a retiree or a pre-retiree wanting to take more measured risk. So the next slide is going to talk about the three options. So Innovator has basically, there are other alternatives. I don't like to get overly fancy. So the buffer ETFs I will talk to you about is either a buffer, a power buffer, or the ultra buffer. So from left to right, we have probably the most conservative, I would say, is the 15% in the middle. So if somebody says, hey, listen, I don't want to lose a lot, but I do want some upside, that's the middle. But let's start left to right. The way this works, and I'm going to use the S&P because that's the only option on the regular buffer, is just the S&P. And that index, let's say it started at 1,000. These are purchased every month on the first of the month, and they get a letter. So it might be the Innovator has been ingenious with how they create them. They name their buffer, the first one, letter B for buffer. And then if it's January, it's JAN. So these are all tracked and measured and traded securities. And so if you buy it in February, BFEB. So now June would be the next one that's available, right? So BJUN. On the first of the month, it's a 1 year point to point on the S&P index. So let's say you started at 1,000. The one thing that's unknown right now is it really depends on the volatility the day before the 31st of May, right? Versus what they give you as a cap. What is a cap? Well, the market has unlimited upside potential, but none of us on this call have a crystal ball. So what it does is it allows us to say, hey, the measurement of the options market says that we have volatility. The best cap that we can offer in this example, I'm going to say, is 10%. That means by June 1st of the following year, that if that market went up 15, so your 1,000 went up 15%, right? So you finished up at 1150. Let's say it had a 10% cap, all you would get credited is 10%. So that's the upside. This buffer has a hard downside of 9%. That means if it went down 10%, so the index went down to 900, that's a 10% loss. You would only, on $1,000 investment, experience a $100 loss. Because there's that gray area, that buffer, that's why it's called a buffer. It's a guardrail. So the trade-off is we're giving up some of the upside, and we never know what that upside is until the month of the actual option date, right? Which is the day before, close of business the day before, they'll lock in whatever that is. Could be 5%, could be 8%, could be 10%. Whatever that number is, that portion would get credited that amount. If it's above or anything in between, you get what you get, but you didn't lose any money. So it allows us to have some participation in the equities without a lot of, or with reduced risk. Okay. Now I mentioned to you that the power buffer, the one in the middle, works the exact same way, but it's a 15% buffer, but it has some other options available. So let's say you go, I don't think the US economy is the place I want to be. So I want to be in the NASDAQ 100 or the Euro, which is EFA, or maybe small caps. I'd rather be in there. So you can pick whichever index and then say, hey, but it works the exact same way as far as caps and buffers. But in my example, now if it's 1,000, the buffer is down 15%. So let's say we were still in the S&P, would have to go down to 850 before you experienced any loss. So if it went down 20%, in my example, went down to 800 on the following year, you would only lose that 5% difference between the 20% market correction and the 15% buffer. So again, it's a guardrail, it's a buffer. Now this ultra buffer, it's still conservative, and it just adds a level for that, oh my God, the sky is falling mentality. But it's not completely, like I said, if 2008 happened and we have roughly a 50% correction, so the first 5% down, right, you're going to experience it. But then if it turned around and went 50%, you have a buffer for 30%. And then after that, the difference between, so 35, that's where that -5 and -35. So that's a 30% spread there. So you would, on 50%, you would have 15% between the -35 and the 50. So that's 15 plus the -5 on the top side for a total of -20 down. So it's not completely risk-free, but you didn't take a bath at a 50% loss. And then, if the market went down 50%, the question is, where's it going from there? And again, I have no idea. And this is not intended to be an all-in solution for everybody, but you can start to say, hey, I'd like to maybe diversify between 1 or 2 or 3 of these options. So that's the ultra buffer. If somebody is interested in engaging, putting that in, exploring these types of strategies, right? I think they're very, very inexpensive, comparatively speaking. You have the upside potential. We are capped. That cap is determined. And just to recap what I was saying, and sorry for the double language, but 2 meanings. And so the cap on the upside is negotiated, day to 2 days, depending on when the end of the month or the previous month, the close of the market ends, will determine the cap that they offer to investors on a go forward. So again, it's a different thought process. It allows you to maybe start to de-risk some of what you've been doing on a go forward. And if nobody else has talked to you about this stuff, you got to start to ask yourself, just because it's worked in the past, is this still the best strategy on a go forward? So, that's pretty much the topic here. Now I'm going to just take us through a couple of things. A lot of you that are my clients may be getting an email. I did a bomb video this morning inviting you. So next Thursday, I do not have a call. Normally, I do these every Thursday unless I'm out of town. I'm actually in town next week, but because I'm being interviewed by New Jersey 101.5, Eric Scott, I'm going to be in studio, and it will be on Facebook Live. The topic is going to be on custodial care, extended care, long-term care, and the importance of. My staff is going to put into the chat box right now. So if you check your chat, I'm going to check it right now. That link Keith just put in. If you click that link, you're going to be able to go in and attend that. It's virtual from the comfort of your own home. Again, I'm not selling anything. I'm just talking about probably one of the fastest growing epidemics in this country. And if you don't have a plan, we need to really start to think about, what are you going to do? Who's going to take care of you? Forget about the costs. It's that I think most people, and that's what I talked about this morning, most people, I think if you're the primary breadwinner, you start to tend to think, I know that that's a risk, but it's not going to happen to me. I mean, that's typically it's males that think like that, right? But it's beyond that, because it's not whether that happens, it's who's going to be affected, who's going to actually have consequences because of that decision that you elected, for lack of a better term, to self-fund a sickness. You're hoping you don't get sick, and hope is not a plan, whether it be in investing or in preparation for a retirement and long-term care. So this here, what I find is people typically think about this if they know anybody or have experienced this firsthand, they tend to be more receptive to the conversation. But sometimes I'm dealing with households where sometimes there's a very much it's the white elephant in the room, and nobody wants to talk about it. And I'm the guy that's going to talk about it. Again, it's your family, your loved ones that are going to be affected. Children, spouses, siblings, neighbors, whoever that is. Now, how is that person? It's an interrupt of whatever resources you had that were making you afford your lifestyle, that are now redirected to pay for somebody for some type of care. How does that plan work? So if you're not, I got off the phone, actually, an elder care attorney or elder abuse attorney yesterday, that I offered a long-term care policy. I went back and we looked at it. It was, I think it was 2009. He goes, man, He goes, that was the best policy I ever bought. They don't even offer it. The insurance companies actually offered to buy it back from him because it was so rich in benefits. I mean, he's getting like 8-to-1 leverage on his money. It's unheard of anymore, right? And these premiums are locked in. They can't renege on it now. So, there are things you can do. And the last thing I'll say is it doesn't even matter if you actually have some type of condition, right? Remember, life insurance pays if you die. Long-term care is a morbidity issue. So they're challenging you on health issues, right? Cognitive disorders, right? And if you get it to a point where you're very late to the game, you could find that now you're having to exposure financially that you hadn't planned for. So again, I would encourage you to hop on this call next Thursday. And the purpose of this call is to invite you to my live events, which are coming up right immediately after that. So yeah, no call next week. I just went off on a tangent, sorry. So West Windsor will be May 31st, and that'll be 6:30, and that will be over at their convention center. And then Rutgers Business School is offering. I tried to get 2 Saturdays, but it turns out we had June 3rd locked up, but they have an international event. So they said, hey, listen, that's going to take priority. So I have 3 events. I can tell you there's only 100 seats. I've been in the Rutgers classrooms before and done those there. There's only 100 seats. And we are inviting everybody on these calls are getting first invitations, but you will start to see, I just saw another registration come through. Once it's done, it's done. So I'm going to encourage you to do both. Attend the New Jersey Live next week. Share that video link with anybody that you think that might have a need, or maybe you have questions, right? Don't wait to the last minute. You don't have to wait to these deadlines, to have a conversation with us. So feel free to reach out. We really want to thank each and every one of you for taking time out each week in your call. And then here's my my disclosures, because if you want to sign up for the event, go to PPS-LTC. That's the link that'll take you directly. You can go to my website. It's there too, but if the shortcut is pps-ltc.com, you can register right there and lock up a seat at one of the events. So without further ado, I want to thank everybody and reach out if you have questions.